Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each week, we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome Shalin Bhagwan, Chief Actuary at PPF. Welcome to the show, Shalin.
Good afternoon, and good afternoon to all your viewers and listeners, Charlotte. It's an absolute pleasure to be with you this afternoon, and thank you very much for inviting me onto the podcast.
Delightful to have you here. Do tell us, Shalin, what is your news story of the week?
Well, Charlotte, my news story of the week is the developing story about the increasing chance of the levy, the PPF levy, no longer being charged in the future. And whilst this seems like quite a niche issue, as most defined benefit pension funds will tell you, corporate defined benefit pension funds have been paying a PPF levy for the best part of 20 years and clearly have a keen interest in ensuring that not only is the defined benefit system adequately backstopped by the PPF, but as importantly, they want to make sure that the PPF is robust in its assessment of just how much of levy we need to collect in the future years. And we have been working with policymakers over the last while to ensure that people understand that our current financial position is such that we believe that the PPF is in good financial health, which should allow us to weather future storms, future events in the DB ecosystem sufficiently without having to charge a levy. And therefore, currently, there are provisions in the Pension Schemes Bill making its way through Parliament, which would allow us and our board the comfort to ensure that we could move to a zero levy if those provisions were adopted, and still have the necessary comfort that were events to develop in the future that would require us to charge a levy again, that we could do so, recognizing, of course, that the PPF is in good health, and so is the rest of the DB system, and long may that continue.
Yeah, well, this is rather fun. I think this is the second time on the Professional Investment Podcast that the news story of the week has actually quoted the guest who is on the podcast. So maybe it's not surprising you chose your news story of the week. But let's take a little step back and let's see how far we've come, because you talked about it looking like it's niche, but actually it is the fundamental underpinning of our DB pension system. Take us back, Shalin, to the days when the PPF was set up and what things were like back then.
Yeah, that's a really great context-setting question, Charlotte, because I was reminded of this earlier this year when at an 20th anniversary event hosted at the Houses of Parliament, some of the founding policymakers who were involved in establishing and lobbying for the PPF to be established were present and reminisced on the environment back then and how, and I remember the quote by one of them was that, just over 20 years ago, your holiday was protected, but your pension wasn't. So if your travel operator went bust, your holiday would be protected, but if your sponsor went bust, your pension wasn't protected. And fortunately, we're in a position today where, due to the foresight of those policymakers, the PPF was established back in 2005. And, I was also reminded of the fact that a few short months after the PPF was established, we had one of our first large claims, the MG Rover scheme, which ultimately transferred into the PPF and which saw the benefits of over 6,000 members being secured as a result of the PPF being in existence. I think people also forget that whilst the DB corporate system back in 2005, just prior to the global financial crisis, was in a in a generally good state of health, with a sort of funding level back then on the PPF basis of about 97% and a deficit for the schemes that were in deficit of only £76 billion. Significant deterioration as a result of the remarkable bond bull market that we saw the deficit of schemes in deficit rise to as high as £450 billion in 2016, and a funding level on a PPF basis of only 85%. So it's great that as we sit here today in 2025, we sit with the funding level of 128% and the deficit of schemes in deficit as low as £30 billion. So we've come a long way with remarkable volatility in our DB system. However, the system looks remarkably robust today, and we see that in some of the risk management strategies, risk reducing strategies that DB corporate pension funds have undertaken over the last decade and last 2 decades or so.
Okay, so refresh my memory. When was the PPF set up? Was it 2005 or was it before then?
2005. So that. Yeah,
so we're at the 20-year anniversary anyway. But why? So aside from the 20-year anniversary, why is it such an important milestone that we have reached this point where there is so much less volatility both in the market and in the PPF's funding? Can you expand a little on that?
Well, I think it's a remarkable milestone because, well, what it means is that as a result of the journey that we've been on over the last 2 decades and the levies that we've charged, we have managed to build the PPF's assets to a fairly robust position, to the point where today we have, roughly speaking, about £31 billion in assets and about £17 billion in liabilities. This creates £14 billion of reserves being held against some of our key contingent risks, including longevity risk and the risk of future claims. What it does mean is that financial position has given us the necessary comfort in order to be able to work with policymakers on provisions for this pension schemes bill to move to a zero levy for the next year and the years beyond it. So, as a result of levy payers paying in, as a result of positive investment returns, which have been running at roughly £1 billion per annum over the last few years, the PPF has managed to build up to this position where we can begin to think about moving away from a levy. And do recall that only a couple of years ago, the levy stood at about £100 million per annum, which is clearly a levy on all DB corporate sponsors. And so it would be a welcome event, were the levy to no longer be charged.
And there's a lot of things to be thankful about in terms of where we are in the cycle on DB schemes, on this, much more, solid footing in terms of funding. And obviously this is great news if the PPF doesn't have to charge a levy anymore. But it would be incorrect to conclude that we've solved all of the issues in the DB universe. We still have a very fragmented universe, which I guess is not surprising given the length of time we've had occupational pension schemes in the UK. That tends to involve the development of these legacy issues. One of those is a lot of fragmentation. We have a lot of smaller schemes, albeit most of the assets are concentrated in the larger schemes. But how should we tackle that fragmentation? Do you think that's something that's going to resolve itself over time? Is that another role the PPF could play?
Yeah, so I think this was started to be talked about 2 or 3 years ago, when many of your listeners will probably recall the Titcomb report, which outlined how, for example, the PPF could potentially, or how government could think about the PPF playing a broader role and leveraging the PPF. And one of the recommendations from the Titcomb report in 2022-2023 was to consider how the PPF could be used as a consolidator for smaller schemes. I think it's important to look more broadly as well, because the Titcomb report was talking about consolidation of corporate DB as just one way in which the government could think about leveraging the PPF expertise, but it also highlighted that government should be looking more broadly at the PPF and thinking about other ways to leverage the core competencies at the PPF. And for those of us that work at the PPF, it's fairly obvious to think about what our core competencies are, but perhaps it's worthwhile reminding listeners that the PPF has three key competencies. We take money in from our levy payers as well as assets of schemes that come to the PPF, and we invest those monies in order to earn investment returns. And this is how we've managed to grow our reserves in order to get to the financial position we are today. So we have a core competency in investing money. We then clearly need to pay out benefits. We have a core competency in administering pensions. And as many of your listeners will be aware, that is a thankless task and often, lowly rewarded task and fraught with complexity. It's something that we pride ourselves on and we do rather well. And I think the third core competency, which many listeners may not immediately think of, is ensuring sufficiency of reserves. So that core competency is about understanding what sort of risks we are holding reserves for. In our case, it's future claims risks from the DB universe, but much like an insurance company or an annuitant provider, we also need to ensure that we have sufficient reserves to protect or to provide for future pensions, which are subject to longevity risk, for expenses, and all of the things that goes with running an annuity portfolio, and we have a roughly £17 billion annuity portfolio. So those are three things the PPF has excelled at, and the Titcomb report was really highlighting the fact that the PPF's expertise and skills in those three key areas could be leveraged because as we go through time, the fact that we have a DB system that's diminishing, and it's right for government to think about consolidation in DC space, in the LGPS space, but increasingly it's important for government to also think about how consolidation might play out in the DB industry. Now, the final point I'd mention on this is just that fragmentation point, Charlotte, and perhaps I should have started there, but it might surprise some of your listeners to hear that, about 2,250 schemes, or 45% of schemes by number of the 5,000 out there, are actually have less than £30 million in assets each. And that the total assets across those 2,250 schemes is only roughly 21 or 22 billion pounds, and they have liabilities of 25 billion pounds. In fact, if you drill a bit deeper and you look at schemes that were less than 5 million pounds each, there's about 800 of them, and about half of them are in deficit. And the total AUM across those 800 schemes is only 2 billion pounds. So we're talking about a very, very long tail. And I believe that, all solutions should be on the table in terms of an end game strategy. For some of those schemes, a buyout or buy-in solution through an insurance company will be the right solution. And for others, who cannot get to a buyout or buy-in solution for whatever reason, we need to consider how those schemes could run on in a cost-effective way, and again, a consolidator, which the PPF, could participate in, is something which would allow that to happen.
I'm smiling and laughing here because I think this is a very eloquent and good sales pitch for why the PPF should be a consolidator, Shalin. I think you deserve to be in front of select committees. I think you're wasted on just the professional investment podcast. In fact, I'm laughing so much. I've dislodged my headphones. Anyway, that's a great sales pitch. I hope everybody really enjoyed that.
Thank you.
Certainly did. And maybe you never know, there might be some policymakers watching this podcast too. So you mentioned there about buyout, and that might well be a solution for a lot of schemes, and we have seen buyout trickle down to smaller schemes. At the beginning, it was very hard for medium and small size schemes to actually access buyout. It was very much a large scheme purview. But we are now seeing more market entrants and that becoming easier. But the other thing, of course, we've seen is a debate that's really heated up over the last 12 months or so about whether we should be considering buyout and whether actually run-on might not be a better option for some schemes. And that gives a lot of options both to sort of the companies that run those schemes, the trustees, and of course let's not forget the consultants and the asset managers too. They also benefit from run-on. So in a run-on scenario, we do have a way for that company and the trustees to access the surplus, either to refund perhaps some of the many millions that they've sunk into the scheme, or to actually increase the benefits to their DB members. How are you seeing this buyout versus run-on debate shaping up? I mean, I think you and I talked about it on a panel just before the summer. How's that debate shaping and moving?
Yeah, so, I think the new surplus flexibilities that have been discussed for some time now have ultimately given both trustees and sponsors pause for thought. And it's fair to say that there are a fair few trustees and sponsors discussing what the new flexibilities could mean for their pension funds. And therefore, some have adopted a wait or see approach. The way I see it is that, again, back to my earlier point, I think it's important that we have a variety of feasible end-game solutions for the different pension funds, whether that be the insurance solution, run-on, or indeed consolidation. Within the run-on space, I think, again, it's important to understand that, I've seen various studies done which suggest that run-on is a viable solution for many pension funds. However, again, a certain minimum amount of assets is necessary for run-on. Now, we can debate where that threshold might lie at 100 or 200 million pounds. I've seen various consultants put out different thresholds which they see as feasible. But I think, again, back to my earlier point, let's not forget about the 2,250 schemes that are below 13 million pounds in assets and the 800 of those below 5 million pounds. Where do those fit in? So I think that's the first question we need to answer as an industry. The second point on the run-on versus buyout debate is that I see pension funds increasingly, and we see this from the asset managers we talk to, the consultants we talk to. We're very encouraged by the fact that there seems to be an asymmetrical approach to managing risk in the corporate DB industry. And what do I mean by that? Well, as funding levels are improving, corporate DB schemes increasingly take the opportunity to de-risk. And they do this by investing in LDI strategies, but increasingly corporate credit strategies and other credit strategies for yield enhancement. Our best view is that as the run-on debate emerges, more of them will choose to look at corporate credit and contractual income type strategies in order to better match cash flows and still earn extra return. But again, all done within a fairly tightly controlled, risk managed way. We don't see lots of pension funds swinging for the fences. So in other words, this is about, to use a cricketing analogy, this is about accumulating the runs by taking singles rather than by swinging for the fences. So that is very encouraging, clearly, for us as the PPF. I think on the flip side, what we've also seen is that funding level triggers for hedging or for reducing risk, back to the asymmetrical point, they tend to result in increased risk reduction when funding levels improve, but risk isn't increased in a proportionate way when funding levels reduce again. So that's also encouraging for us at the PPF. So as our CEO mentioned only a few short weeks ago, we think that the approach to run-on that's been adopted in the corporate DB industry is a sensible one from what we can see so far. We think we need more clarity on which will come from TPR and others in terms of what the shape of this these surplus flexibilities will look like and how they may be applied in practice. And I think once we have that full detail, then we'll be in a better position to make an assessment. I do think there's one final point to mention, which is that clearly the decision to run on is is one that the trustees ultimately, have a huge amount or carry a huge amount of responsibility for. And increasingly, we live in a world of professional trustees and dominated by professional trustees who will take that responsibility very seriously. And so I think it's important that professional trustees feel like they have the comfort that they need in order to make the decision to run on, especially when so many schemes find themselves in a position where potentially they could buy out. And ultimately, that's going to be a trade-off that's going to have to be made by the trustees, weighing up the risk reward between buyout or buy in, which which has been seen as the gold standard for so long, versus run on.
Yeah, you made a very interesting point there about investment strategy, and this is the Professional Investment Podcast, that you see a lot of these schemes wanting to invest. I think I could paraphrase what you said by like an insurance company and pursuing more sort of global credit portfolios. I mean, there is a concern, isn't there, that if we have all of the insurers doing buyout, pursuing global credit portfolios, and then schemes thinking about buyout or run on just because they want to maintain that funding level and not risk it, do we have too many people chasing the same asset class? Is there enough sort of liquidity within credit? We know already that schemes and insurers are having to move out of the UK credit market into the global credit market. Is there an opportunity there for other asset classes to come to the fore that would meet all of the stringent requirements, either of the insurer or even of a pension scheme that wants to be insurance-like?
Yeah, so I think there's a few things there. I think it's important to recognize that, so the mantra, as you know, from many asset managers talking to pension funds is, invest like an insurer, but think like a pension scheme. So effectively what that's saying is, let's look at some of those credit assets which don't necessarily have or tick all the boxes that an insurer may require from a Solvency UK perspective in order to be capital efficient. So things like fixity of cash flows, prepayment risk, etc., which the insurers are really concerned about in order to get the full what's called the matching adjustment benefit under Solvency UK. Insurers don't need to be wedded to the same assets and therefore don't need to chase up the prices on those assets by all chasing the same assets. So I think the advantage of run-on from a pension fund perspective is that they're able to look a bit more broadly than these, if you'd like, the Solvency UK eligible universe of assets, so that they don't need to chase the same assets as the insurance companies, and they can invest a bit more broadly. So yes, there are risks around liquidity. I think the counter argument against that would be, from an insurer's perspective, clearly these are buy and hold portfolios. The whole point about the matching portfolio adjustment or the matching adjustment is that you are buying an asset which you expect to hold to maturity, and the cash flows are being matched against the liability cash. So liquidity, you shouldn't be a forced seller of that asset. And so the whole Solvency UK framework really does revolve around that. So that gets me a little bit more comfortable. In terms of expanding the asset set, absolutely. I mean, I think pension funds are already doing that by looking at a broader asset set across both public and private credit markets, as well as potentially also thinking about how they construct so-called CDI or cash flow driven investing strategies. These are increasingly coming to the fore. And so I think that combination of LDI and increasingly CDI means that pension funds are allowing themselves to look at a broader opportunity set than simply, say, global IG credit.
Yeah, I think that's right. We need to diversify and we need to think a bit more broadly. And as you say, there is a sort of, you can call it a regulatory arbitrage benefit of being in a pension scheme and not an insurance company that should give you greater flexibility. I want to come back to kind of our original point about the PPF levy, and this whole discussion started by saying that it's something that you could get rid of. But if we link that back into the buyout and run-on debate, one suggestion has been that one way we could encourage more schemes to run on would be, in fact, through a small PPF levy, which would help to sort of break down the link between that scheme and the sponsoring company, and maybe would encourage more schemes to go to run-on rather than buyout. What do you feel about that? We've spent most of the time talking about we're going to get rid of the PPF levy, but then we've got this other bit of the market that wants to bring in a new levy. How do you think that debate is going to evolve?
Yeah, so I think the first observation I'd make is that there are two potential ideas that have been discussed over the last, certainly last 12 to 18 months, if not longer. The first idea relates to what I'm going to call an optional or an opt-in type levy. So in other words, this is the concept that a pension fund could elect to receive 100% protection from the PPF. In other words, cover scheme benefits fully, but on an opt-in basis. So this was the method. This was the option, no pun intended, that government consulted upon, and that was the option which government chose to shy away from or not take forward due to some of the complexities, the self-selection effect, the quite frankly the cost of doing it. And I think certainly on an opt-in basis, you can imagine, you'd be talking about a very small number of pension funds having to effectively pay a premium to insure themselves. And the take-up rate would be uncertain, pricing it would be difficult to say the least. It's a fairly, I would say, intractable problem to solve. So that's the first idea that was discussed and was consulted upon. The second idea, which has come into the frame more recently than the first idea, was this concept of actually could it be possible for the PPF to provide 100% protection for the entire universe. Now that's an entirely different proposition and not one that was specifically consulted on. But the idea here is that all pension funds would benefit from 100% PPF protection. However, equally, all pension funds would be liable for the 100% levy. I think the point to think about in that context is the fact that it comes back to an earlier point I made about trustees fiduciary duty. And, it's really a discussion with trustees as to how comfortable or otherwise trustees feel about running on a pension fund, fulfilling their fiduciary duties in the face of a pension fund which might be sufficiently well funded in order to achieve buyout, and how do they weigh up the risk-reward trade-off from that decision that they have to make and the potential liability arising from that decision, and how they think about their fiduciary duty and their own liability in terms of making that decision. And that's where potentially the discussion, as I've heard it, is that some professional trustees feel that this universal, what I'm going to call the PPF universal underpin, would be more helpful in that regard in facilitating run-on. I think the final piece of the puzzle is one which is uncertain. There's been a few numbers bandied about, and that is just how effective will the surplus flexibilities be in ensuring that more assets get deployed into the UK economic or growth agenda, UK productive finance. And we've seen varying estimates, anywhere from 10 to 160 billion. Now, it's fair to say that most people I speak to see numbers coming in at the lower end of that range and feel that in order for that number to be at the higher end of the range, trustees need more comfort in order to take the decision to run on rather than buy out, and that it's difficult in the current environment to do so. So all of that's a rather long-winded way of saying, ultimately, these ideas will, I guess, live or die by just how successful the surplus flexibilities are, and what sort of uptake we see in pension fund trustees, using those surplus flexibilities, and the jury's quite frankly still out on that. And so, I guess, watch the space.
So my final question, I want to pick up on something that we discussed in the first episode of Series 4, which was last week, where we talked about pension adequacy. Now, you're sitting in the wonderful world of DB, Shalin, and we know that people who retire with a DB pension, well, they have lots of things that are going for them. They've had a much greater, much higher contribution level paid throughout their lifetime. They have a guaranteed income that's also inflation linked. And that's very different to the world of DC, where we see lots of discussion about contribution levels. Little idea that we're going to see that moving anytime before the next parliament. And also this very different attitude or different proposition for people who are going to start to retire, where they get a pot rather than an income. How do you think we should be thinking about pension adequacy? Is there any things that we should be really focusing on to tackle up front?
Yeah. I think I have a huge amount of empathy with this issue, partly because I started my career in South Africa, and I actually was a member of a defined benefit pension scheme. In South Africa in the early to mid 1990s, saw a great transition away and closed down DB schemes. Not only did they close down defined benefit schemes, they offered enhanced transfer values to members of defined benefit pension schemes to transfer to defined contribution schemes. And I saw all the complexities that came with that, and some of the challenges that came, in with moving to that DC framework. And also, that DC environment has been in place for some 30 years plus now, and I can see some of the challenges that have manifested. So I have a huge amount of empathy for this issue and a huge amount of interest in this issue. It's fair. I'm glad you described it as a pot, not an income. And I think this is this has been and will continue to be one of the great challenges of our time, is understanding how to create a sustainable income in retirement. And, we've had many people write about this. There's lots of research done. We've got things like the spending rule, is it the 4% spending rule, and all sorts of rules of thumb about how to draw down an income. But ultimately, what this comes back to is the socialization or the pooling of risk in retirement. And it's the pooling of not just investment risk, but also longevity risk, and that idea of risk sharing in order to provide a sustainable income, certainly a sustainable basic income for one's retirement, because most people are simply not equipped to make that decision as to how to make their pot last over a lifetime. And I think this comes back to an earlier point I was making, and at the risk of playing into the perception that I created early on in the conversation. The PPF does a few things well, right? We pay pensions well, we invest money well, and we also understand how to reserve for future liabilities, and so. I think there is something to be thought about in terms of converting pots into an income. That is the domain of the insurance companies. They do an excellent job. It's within a Solvency UK regulated regime, and I think they perform an excellent role. I think it's important that we, however, begin to understand, what do we do with small pots? Because it's all well and good approaching an insurance company and buying an annuity when you have a large pot. However, how do we do that cost effectively for smaller pots? My contention is that it is not cost effective to convert a small pot into an income in the solvency framework, with all the costs associated with doing so. And so I think what we need to think seriously about is, what do we do for people with smaller pots? Because if we continue at the rate that we are continuing at, i.e. lower contribution rates than some of our developed world competitors. You'll know that Australia, Canada, and others have higher contribution rates than we do in the UK. And look, our situation has one that has evolved, and so I don't wish to suggest that Australia or Canada are in a better position simply because they have higher contribution rates than us. I think we need to understand that each pension system is unique and evolves from a different starting point. We will no doubt evolve to higher contribution rates at a point in time when that makes more sense for us as a country and as an economy. However, in the here and the now, we have to think about people approaching retirement with small pots. What is the solution for them to have a sustainable income? Is it buying an annuity from an insurance company? Are there other options that that government and policymakers should be thinking about? And I'll leave it at that.
Well, I think that's a great place for us to end our discussion, Shalin. I might have to propose a new job title for you. I'm not sure that Chief Actuary quite covers it. But who knew that talking about the PPF could make me laugh so hard that I'd lost my headphones? Long may the podcast continue in this vein. Listeners, if you want to make sure you never miss a moment in the future where I laugh so hard I lose my headphones, or indeed a future episode, then make sure you hit the subscribe button. Please do engage, take part in our polls, and thank you so much for listening, and thanks for being on the show, Shalin.